Welcome to the Deep Dive, your shortcut to being well informed. Today, we're diving headfirst into a topic that really touches almost everyone with an income: tax deductions and losses. You know those moments when you're staring at your tax forms trying to figure out what actually counts, and it feels like, I don't know, like you need a secret decoder ring?
Yeah, we've definitely all been there.
We have. So today, we're taking a deep dive through this, well, intricate world of deductions and losses. We're pulling the most important nuggets from the instructor guide, Individual Income Taxes 2026, Chapter 6. Our mission here is really just to give you a clearer framework, what really impacts your taxable income, helping you see the difference between deduction types, understand the timing, spot pitfalls, and maybe even unlock some tax planning ideas. By the end of our conversation, hopefully, you'll have a much stronger grasp on how to navigate this essential part of your financial life without getting totally lost in the weeds.
That's right. And it's really crucial to remember that a deduction isn't just automatic. It's often called legislative grace, meaning you only get it if the law specifically allows it.
Ah, okay. Legislative grace. I like that.
Yeah, understanding those allowances is really the first step to smart tax management.
So let's jump right into what I think is the absolute foundational distinction here. The difference between deductions for adjusted gross income for AGI and those from adjusted gross income, the itemized deductions. Why is this split so incredibly important?
It's absolutely critical because these two categories, they just play by completely different rules on your tax return.
Sure.
For AGI deductions, they're claimed directly against your gross income to actually calculate your adjusted gross income.
Okay.
So they always give you a benefit no matter what. You can think of them as expenses that help define your income for tax purposes. They reduce your income dollar for dollar right off the top.
Right off the top.
Yeah.
Got it.
Now, from AGI deductions, your itemized ones, they're different. They only give you a tax benefit if their total amount adds up to more than your standard deduction.
Which for a lot of people it doesn't, right?
Exactly. For many people, the standard deduction is higher, so those from AGI expenses might not actually save them any money on their taxes.
So if I'm hearing you right, A for AGI deduction isn't just lowering my taxable income. It's also kind of a powerful lever. It can unlock or even expand other deductions further down the form. Am I getting that strategic advantage?
You've got it, exactly. That is the real insight. A lower AGI can be a game changer. For example, medical expenses, they're generally only deductible for the amount that exceeds 7.5% of your AGI.
Okay.
And personal casualty losses, they have a 10% AGI floor. So if your AGI is lower because you had some good for AGI deductions, those percentage floors are also lower. It just makes it much easier to actually claim those itemized deductions.
Oh, like a compounding benefit.
Precisely. It's a compounding tax benefit.
That makes perfect sense. So how do we even begin to tell them apart? Is there like a simple rule, or do we always have to dive deep into the tax code specifics?
Well, there's a pretty clear rule of thumb, thankfully. The tax law, specifically Section 62, it has a list of what qualifies as for AGI.
Okay.
If a deduction isn't explicitly on that list, then it's generally an itemized deduction, meaning it's from AGI. It really comes down to knowing where the IRS draws that line.
Okay. Let's explore some of these four AGI categories then. What are the main ones we should really be aware of?
Our sources highlight three key categories.
Yeah.
The first one involves expenses related to investment or the production of income. Section 212 expenses, technically.
Okay.
These are costs you pay for, producing or collecting income, managing property held for income, or even expenses tied to figuring out your taxes.
Can you give an example?
Yeah, sure. A great example is expenses for rent and royalty income, the stuff you'd report on Schedule E, or maybe professional fees for a sole proprietor on Schedule C or a farmer on Schedule F. But here's a really crucial detail. Other investment-related expenses, like, say, investment interest expense, those are actually itemized deductions from AGI. And this is where it gets tricky for a lot of people. Many common miscellaneous itemized deductions, like, remember, safe deposit box rentals, those are not deductible at all right now from 2018 through 2025.
Wow. Okay. So the type of investment really matters.
Huge difference.
That's a huge distinction. So this raises a good question. Think about Larry and Susan. They both invest $10,000, both have $800 in expenses. Why might Susan's expenses be for AGI and Larry's just not deductible at all?
Yeah, this scenario really nails the impact of classification. Susan, based on her source material, likely invested in rental or royalty property. Expenses for that kind of income are specifically listed as for AGI. Larry, though, with his other investment property, Well, his $800 in expenses would fall into that miscellaneous itemized deduction category, which, as we just said, are currently suspended, not deductible.
So same money spent, totally different tax outcome just based on the type of investment.
Exactly. The nature of the investment fundamentally dictates the tax treatment.
Okay. What's the next category?
Moving on, the second major for AGI category is trade or business expenses. Section 162. This is kind of the main legal authority for deducting costs linked to running a business. Now, there isn't one single definition of trade or business, but avoiding the hobby label is absolutely key here. We'll probably talk more about that later.
Right.
And the tax code also specifically excludes certain things, even if they feel business-related, like charitable contributions, illegal bribes, fines, penalties. Those aren't deductible business expenses.
Okay, so when a business spends money, what's the IRS looking for to say, yep, that's deductible? What are the key criteria?
Good question. To be deductible, whether it's for a business or an income-producing activity, an expense generally needs to meet two core tests.
Yeah.
It has to be ordinary and necessary.
Ordinary and necessary.
And if it's compensation, like salary, there's a third test. It also has to be reasonable.
Okay, what do those mean in practice?
Well, ordinary just means it's, normal, usual, customary for that type of business. It doesn't have to happen every single year, just has to be typical. Necessary means a sensible business person would incur it. It's appropriate and helpful for the business.
Makes sense.
And reasonable, especially thinking about salaries paid to owners or their families, means it's not excessive given the circumstances. You can't just pay yourself $1 million for a part-time job in a small business and expect to deduct it all.
Right. So could something be ordinary but not necessary?
Absolutely.
Yeah.
Think about a fine for violating a law. It might be ordinary if lots of businesses in that field get fined and the amount might be reasonable. But paying a fine isn't considered necessary for tax purposes, so not deductible. And conversely, maybe a super high salary paid to a key employee who's also a shareholder is ordinary and necessary, but if the amount is just way out of whack, not reasonable, then the excess part could be disallowed as a deduction.
That distinction between ordinary, necessary, and reasonable seems really critical.
Okay, what about personal expenses? It feels like the IRS draws a super hard line there, but are they ever deductible?
You're right, they draw a very hard line. Personal expenses are only deductible if a specific part of the tax code explicitly says they are, and almost all of those authorized personal deductions are from AGI itemized deductions.
Like what?
Think about things like qualified charitable contributions, mortgage interest on your home, state and local taxes up to the limit, or medical expenses above that AGI floor we talked about.
Got it. And losses. We hear about deducting losses, especially after, unfortunate events.
Yeah, Section 165 allows deductions for losses you aren't compensated for by insurance. But for individuals, these are generally limited to losses from your trade or business or transactions you entered into trying to make a profit.
Okay. And here's a really crucial point for personal losses. Personal casualty losses like damage to your home from a fire or storm are only deductible if the loss happens in a federally declared disaster area.
Wow, only if it's a federally declared disaster. That's a big restriction.
It is. It changed a few years back. It's a significant limitation for homeowners now.
So what does this all mean for someone like, say, Dave? His building burns down. The second floor is his home. The first floor is his business. Are the tax consequences the same for both parts?
That's a perfect scenario to highlight these distinctions. The loss on the business portion, that's for AGI deduction. And it doesn't matter if it was in a federally declared disaster area or not. That loss is generally deductible as a business loss.
Okay.
But the loss on the personal residence portion, that's an itemized deduction from AGI. And it's only deductible if that fire happened in a federally declared disaster area.
So, same fire, two different outcomes on his tax return.
Exactly. If it wasn't a declared disaster, he gets no tax benefit for the damage to his home, only for the damage to his business space. Dramatically different results.
Okay. Now, another significant from AGI deduction for a lot of individuals is the qualified business income deduction, right? QBI. That sounds like a big win for small businesses.
It absolutely can be, yeah. The QBI deduction allows individuals to deduct up to 20% of their qualified business income. This comes from things like sole proprietorships, partnerships, S corporations. Those flow through businesses.
So it helps lower the tax on that business profit.
Right. It helps reduce the tax burden on that income. It's important to note, though, it doesn't reduce your income for self-employment tax purposes, just for income tax.
Ah, okay. What kind of income doesn't count as QBI?
Good question. QBI excludes wages you earn as an employee. It also excludes capital gains or losses, dividend income, and most interest income. It's really targeted at the operating profit of the business.
And are there limits?
Oh yes, there are significant limitations. Once your taxable income gets above certain thresholds, for 2025, we're talking around $400,000 for married filing jointly, about half that for others. The deduction can be capped.
Capped based on what?
It's capped based on either 50% of the W-2 wages paid by the business or a combination of 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property the business owns. It gets complicated.
Yeah, sounds like it.
And there's another layer. Certain types of businesses called specified service trades or businesses, think health, law, accounting, consulting, athletics, financial services, they face these limitations at much lower income levels, and the deduction can even phase out completely for them if their income is high enough.
So it's definitely not a simple 20% deduction for everyone.
Not at all. It's targeted, and the rules can be complex, especially for higher earners or those service businesses.
It sounds like a lot to keep straight, but ultimately, all these different classifications, for AGI, from AGI, QBI, they all eventually lead to where you report them on your tax forms, right?
Precisely. Your for AGI deductions often land on the main form 1040 or on Schedule 1. Your itemized from AGI deductions go on Schedule A. And then you have all the supporting schedules like C for business, E for rentals, F for farming. They all feed into these main forms. It's like an interconnected system trying to capture all the different pieces.
All right, let's shift gears then. We've talked about what is deductible and where it goes. Now let's talk about the when. How does your accounting method impact when you actually get to deduct an expense? Because timing can make a big difference, can it?
Timing is absolutely critical, yeah. And your accounting method is really the foundation here. Most individuals and many smaller businesses use the cash method.
Okay, cash method.
If you're on the cash method, an expense is generally deducted when it's actually paid. When the cash leaves your hand or you charge it or the check clears. Simple concept.
Seems straightforward.
Mostly. The main caveat is for big capital expenditures. Buying a building, major equipment. You don't deduct the full cost immediately. Instead, you recover that cost over time through depreciation or amortization. Yeah, you spread it out.
Okay, so you don't get the big deduction all at once for major assets. What's the alternative method?
The other main one is the accrual method. This is used by many larger businesses. Under accrual, expenses are generally deducted when they are incurred, not necessarily when they're paid.
Incurred. What does that mean exactly?
It means two tests have to be met. First, the all events test. The liability has to be fixed, and you can determine the amount with reasonable accuracy. Second, the economic performance test must be satisfied.
Economic performance.
Yeah, that generally means the service or property that created the liability has actually been provided to you, or you've used the property. So you might have a fixed liability, but if the work hasn't been done yet, economic performance hasn't occurred, and you usually can't deduct it yet under accrual.
Okay, that sounds more complex than the cash method.
It can be. There are some exceptions, like the recurring item exception, which lets you deduct certain predictable expenses a bit sooner if they meet specific criteria. And sometimes there are interesting rulings, like one court case mentioned in our source, that let accrual businesses deduct the value of customer loyalty points when awarded, not waiting until they were redeemed. That can be a big timing difference.
That's a good distinction. So thinking about timing, what about prepaid expenses? Like if I pay my business insurance premium for the whole next year in December.
Prepaid expenses. That often brings up the 12-month rule. Generally, you don't have to capitalize, meaning delay the deduction for amounts you pay to create a benefit that doesn't last beyond the earlier of either 12 months after you first get the benefit or the end of the next tax year.
So for that annual insurance premium paid in December.
Right. Since the benefit, the insurance coverage, doesn't extend more than 12 months beyond when it starts and ends before the end of the following year, a cash basis taxpayer could likely deduct the whole premium in the year they paid it.
Even if it covers part of next year.
Yep. But remember, even with this 12-month rule, accrual method taxpayers still generally need to satisfy that economic performance test. So the rules can interact in complex ways.
Okay. Beyond just cash versus accrual rules, there's also this strategic idea of the time value of tax deductions. Why does timing matter so much from a planning perspective?
It matters for a couple of big reasons. First, just the basic time value of money. $1 saved in taxes today is worth more than $1 saved in taxes next year, right? You can use that money now.
Sure, makes sense.
Second, and this is really critical for tax planning, you have to think about potential changes in your marginal tax rate, your tax bracket.
Ah, because the value of the deduction depends on your rate.
Exactly. Accelerating a deduction into this year might seem good, but what if you expect to be in a significantly higher tax bracket next year? Waiting to take the deduction then might actually save you more overall tax. You want the deduction in the year, gives you the biggest bang for your buck.
So it's not just about getting the deduction sooner, it's about getting it when it saves you the most tax. Requires looking ahead.
Precisely. It requires some foresight and planning around your expected income and tax situation.
Okay, let's unpack some of the no-go zones now. The IRS is pretty deliberate about stopping taxpayers from deducting things that are really personal or maybe against public interest. This part of our deep dive is all about what's not allowed.
Yeah, this is where the tax code draws some very clear and sometimes thick lines. Often it reflects public policy. The government isn't just trying to collect revenue, it's also trying to, encourage or discourage certain behaviors.
So what's first on the disallowed list?
Well, first up are public policy limitations. Basically, payments that violate public policy are just not deductible. Full stop.
Like what?
Think illegal bribes or kickbacks. Fines or penalties paid to a government for breaking the law. You can't deduct your parking tickets or speeding fines, even if you got them while driving for work. The government isn't going to give you a tax break for violating its own rules.
Okay, that seems logical. What else?
Then there are legal expenses. Now, legal fees can be deductible if they're directly related to your trade or business, or to an income-producing activity. We mentioned legal fees for rental property being for AGI.
Right.
But legal expenses for just general tax advice on your personal return or for things like divorce, those usually fall under miscellaneous itemized deductions. And again, those are not deductible from 2018 through 2025. So context matters hugely.
Got it. Personal tax advice fees are out for now. What about illegal activities?
Illegal business expenses. This is a really fascinating area. Generally speaking, the ordinary and necessary expenses of running an illegal business, think maybe an illegal gambling operation, those expenses are deductible. Rent, wages, depreciation.
Really? You can deduct expenses for an illegal business?
Generally, yes, for the ordinary and necessary operating costs.
Yeah.
However, you still can't deduct the illegal payments themselves, like bribes or fines associated with it. And there's one huge exception: drug dealers.
Drug dealers.
Yeah, the law specifically singles them out. They are not allowed to deduct any ordinary and necessary business expenses, except for the cost of goods sold, basically, what they paid for the drugs they sold.
Wow. So the law allows deductions for some illegal businesses, but not others.
Exactly. Cost of goods sold is seen differently in the tax code, more like a reduction to arrive at gross income, not technically a deduction from it. It's a very specific and punitive rule for drug trafficking.
Okay. What else is generally off limits?
Political contributions and lobbying. Generally, no business deduction for payments made to political campaigns or candidates, or for most expenses related to lobbying, like trying to influence federal legislation or high-ranking government officials.
So businesses can't deduct lobbying costs?
Not usually. There are some minor exceptions, like for monitoring legislation or very small amounts of in-house lobbying, but the general rule is no deduction.
Okay. How about executive pay? I hear about limits there sometimes.
Yes, excessive executive compensation. There's a rule often called the millionaire's provision. For publicly held corporations, there's a $1 million annual ceiling on the deductibility of compensation paid to certain top executives, the CEO, CFO, and the next three highest paid.
So the company can only deduct the first million?
For each of those specific executives, yes. What's interesting, though, is our source material notes that this rule was tightened up in 2018. They removed an old exception for performance-based pay.
Did that make companies pay less?
Apparently not. The source points out it seems to have had no real effect on the continued rise of CEO salaries. In 2023, the median pay for S&P 500 CEOs was way up there, like $15.7 million, mostly in stock and options. It just shows how companies structure compensation around these tax rules.
Fascinating. Okay, what about checking out a new business? Can you deduct those costs?
Investigation of a business. The rules here are designed to prevent abuse, like writing off vacations. It depends on whether you're already in a similar business.
How so?
If you are already in a similar line of work, you can deduct your investigation expenses that year, whether you end up buying the new business or not.
Okay.
But if you're not already in a similar business, if you decide not to buy it, those expenses are generally not deductible at all. If you do buy it, you have to capitalize those costs. You could deduct up to $5,000 immediately, but the rest has to be amortized, spread out over 15 years.
So it really discourages just looking around if you don't follow through and aren't already in the field.
Exactly. It prevents writing off what might just be personal exploration or travel as a business expense.
Makes sense. Now, what about hobbies? Lots of people have side activities they enjoy but maybe make a little money from.
Right. Hobby losses. This is a big one. If an activity has both personal enjoyment and maybe some profit motive, the tax law steps in. Basically, losses from an activity deemed a hobby are deductible only up to the amount of income that hobby generates. You can't use a hobby loss to offset your other income.
So how do you know if it's a hobby or a business?
The IRS looks at a bunch of factors. Are you running it in a business-like way? Do you have expertise? How much time and effort do you put in? Do you expect assets to appreciate? What's your history of income or losses? Even your overall financial status and the element of personal pleasure involved.
Is there a shortcut? Like if you make a profit sometimes.
There's something called a presumptive rule. If your activity shows a profit in at least 3 out of the last 5 consecutive years, or 2 out of 7 for horse breeding, it's presumed to be for profit. The burden then shifts to the IRS to prove it's not a business.
Ah, that sounds helpful.
It is, but it's not foolproof. The profits need to be somewhat significant and come from normal operations. But here's the real kicker right now. Even if you have hobby income, the expenses you deduct against it, things like supplies, maintenance, those would mostly be miscellaneous itemized deductions.
And those aren't deductible now.
Exactly. So from 2018 through 2025, even if you have hobby income, you effectively get no deductions against it. You end up paying tax on the gross income from your hobby.
Ouch. That really changes the equation for hobbies.
It does. It makes the distinction between hobby and business even more critical if you have expenses.
Okay, another tricky area seems to be vacation homes that people rent out sometimes.
Definitely. Rental of vacation homes. The rules here are notoriously complex. It all depends on the mix of personal use days versus rental days.
What are the categories?
Okay, 3 main scenarios. 1, primarily personal use. This is if you rent it out for fewer than 15 days a year. Good news here. You don't even report the rental income. It's tax-free. You just deduct your mortgage interest and property taxes like normal on Schedule A.
Rent it less than 15 days. Income is tax-free. That's simple.
Yep. Scenario 2,
Yeah.
primarily rental use. This is if you rent it 15 days or more and your personal use is minimal. Minimal means not more than the greater of 14 days or 10% of the total days it was rented.
Okay, rent a lot. Use it very little personally.
Right. In this case, you treat it like a regular rental property. You allocate expenses between rental and personal use, report the income, and importantly, you might be able to deduct a loss, subject to other rules like passive activity limits.
Okay, so potential loss deduction there. What's the third scenario?
Scenario 3, personal rental use. This is the vacation home category. It's when you rent it 15 days or more, but your personal use exceeds that minimal threshold, more than 14 days or 10% of rental days.
So a significant mix of renting and personal use.
Exactly. In this case, you still report the rental income and allocate expenses. But like a hobby, your deductions are limited to the amount of rental income. You cannot deduct a loss. The expenses are deducted in a specific order, but the bottom line is no net loss allowed.
Wow. Okay. That 14-day 10% rule seems incredibly important then. It flips the switch on deducting losses.
It's absolutely critical.
So this raises an important question. Let's think about Karen and Andy. They rent their beach house out 200 days a year. They use it personally for exactly 14 days. Right now, they're probably primarily rental, right?
Correct. 14 days isn't more than 14 days, and it's definitely not more than 10% of 200 days, which is 20 days. So they're in the category where losses might be deductible.
Okay, now their daughter wants to use it for spring break for 1 week, 7 days. What should Karen and Andy think about from a tax perspective?
This is a classic planning dilemma, right out of the source material. If their daughter uses it for 7 days, their total personal use jumps from 14 to 21 days.
Ah, and 21 is more than 20 days, 10% of 200.
Exactly. That single week of extra personal use pushes them over the threshold. It flips their property classification from primarily rental to personal rental use or vacation home.
And the consequence?
The consequence is their deductions would now be limited to their rental income. Any potential net loss they might have had for the year, disallowed, gone. That 1 week makes a huge difference to their tax outcome.
Wow, that's a really tangible example of how these rules work. Okay, just a few more disallowance areas.
Sure, quick ones. Expenditures for another person's benefit. Generally, you can't deduct expenses you pay for someone else unless it's a specific exception like medical expenses for a dependent. It's usually better to gift the money to the person and let them pay the bill.
Makes sense. Keep it clean.
And we've mentioned personal expenditures being broadly disallowed unless specifically authorized. Same for capital expenditures. You generally capitalize and depreciate or amortize them over time, not expense them immediately, though there are some de minimis rules allowing small items to be expensed.
Okay. What about selling stuff to family?
Transactions between related parties. Section 267. Big one. Losses on sales or exchanges between related parties are disallowed.
Related parties like who?
Spouses, siblings, parents, children, grandchildren, or a corporation where you own more than 50% of the stock. The tax code basically says you can't manufacture a tax loss by selling assets back and forth within the family or to your controlled company.
So you just lose the tax benefit of the loss?
On that initial sale, yes. There is a potential benefit later. If the related person who bought it eventually sells it to an unrelated person at a gain, they can use that previously disallowed loss to offset their gain. It's called a right of offset. But it can't create or increase a loss on the second sale.
Okay, so the loss isn't totally gone, but it's deferred and limited. Here's where it gets really interesting. Ella owns 60% of Peach Inc. stock. It's gone down in value. She's thinking of selling 5% of her holdings to her brother and gifting 10% to her niece. What are the tax issues?
Okay, classic related party scenario. First, the sale to her brother. Since he's a related party, the loss on that sale would be completely disallowed under Section 267. No current tax deduction for Ella there.
Okay, loss disallowed on the sale. What about the gift?
The gift to her niece doesn't trigger income tax consequences for Ella, but there could be gift tax implications depending on the value. More importantly for the niece, due to gift basis rules, she essentially inherits Ella's loss potential. She wouldn't get any tax benefit for the decline in value that happened before she received the gift, if she later sells it. Her basis for calculating a loss would be the lower of Ella's original basis or the fair market value at the time of the gift.
So neither move really helps Ella recognize that loss for tax purposes right now, and the niece might not benefit from it either.
Exactly. It shows how these related party rules, combined with gift basis rules, can really restrict your ability to get a tax benefit from assets that have declined in value if you keep them within the family.
Very important to understand those rules. Any other major disallowances we need to cover?
Just a couple more quick mentions from the source. Substantiation is huge. You need records. The burden of proof is on you, the taxpayer. The IRS can and will disallow deductions you can't back up with adequate proof, especially for things like travel, meals, gifts.
Keep your receipts.
Definitely. Also, expenses related to tax-exempt income. You can't deduct expenses you incur to produce income that isn't taxed, like interest paid on a loan used to buy municipal bonds. That prevents a double benefit.
Makes sense. No deduction for earning tax-free income.
Right. And there are others. Limitations on deducting settlements related to sexual harassment if there's a non-disclosure agreement. Limits on business interest expense deductions for larger businesses. The list goes on.
It's definitely a complex landscape. Okay, so we've navigated the rules, the timing, the disallowances. How can we apply this proactively? What are some smart moves or tax planning opportunities that come out of all this?
This is where understanding the rules really pays off. First, back to vacation homes. If you own one, actively manage your personal versus rental days. Know where that 14-day 10% threshold is for your property. Decide consciously if you want it treated as primarily rental, potential losses deductible, or personal rental, no losses allowed. One extra personal weekend could cost you thousands in disallowed losses, or vice versa.
So be strategic about your own use.
Absolutely. Second, hobby losses. If you genuinely believe your activity is a business, not a hobby, you need to act like it and document it. Keep separate books, advertise, have business cards, try different strategies to make a profit. Build that case for profit motive. Relying only on the 3 out of 5 year profit rule might not be enough, especially now with the miscellaneous deduction suspension making hobby expenses largely non-deductible anyway.
Treat it like a real business if you want the IRS to.
Exactly. Third, always consider the time value of deductions together with your expected marginal tax rate. Don't just blindly accelerate deductions. Is your income likely to jump next year? Maybe deferring the deduction saves more tax overall. It requires looking ahead.
Balancing today's savings versus potentially bigger savings tomorrow.
Right. And finally, really leverage that for AGI versus from AGI distinction. Actively look for ways to maximize your 4 AGI deductions first. Remember, lowering your AGI doesn't just reduce income subject to tax. It can also lower those thresholds for medical expenses, casualty losses, and potentially make you eligible for other credits or deductions. It's about using the structure of the tax return to your advantage.
So what does this all mean? Wow. We've just covered a lot of ground in this deep dive into tax deductions. We've looked at for AGI versus from AGI, the crucial role of timing and accounting methods, a whole host of disallowed expenses, from public policy things to hobby losses and related party sales, and even how executive pay adapts. Hopefully, after all that, you're feeling maybe a bit more informed, more equipped to spot the important details, and maybe make some more strategic decisions in your own financial life. It's complex, but understanding the framework helps.
Absolutely. And if we connect this to the bigger picture, you see how detailed these rules are, how they try to influence behavior, define what's legitimate business versus personal. It makes you wonder, considering how extensively the current rules try to shape financial behavior and prevent abuse, what might be the next frontier for tax law? What new areas might Congress or the IRS look at to redefine what's deductible, especially as our economy keeps evolving? With the gig economy, digital assets, new kinds of income streams and business models, where will the lines be drawn next?
That is a fascinating question to ponder. What will the next evolution of deductions look like? Thank you for joining us on this deep dive today. Until next time, keep exploring and keep applying these insights.